this needs to get out to the world. This needs to get out to every homeowner, every American. It's a travesty what's happening, and it's happening in D.C. This is the situation, and so follow me here for a minute. Those that make the rules, there's $11 trillion in loans. So if you added up all the loans done in the United States, there's $11 trillion.
Okay.
There's two organizations in Washington, D.C. that kind of package the loan. One's FHFA, and they are the conservators of Fannie Mae and Freddie Mac.
Okay.
And they do the typical conforming loans. Typical 30-year fixed rate, they're called agency loans, and it's most of the money right now. They carry $5.1 trillion of loans, almost half of the loans.
Right.
The other organization is called HUD, and they do Ginnie Mae loans and VA loans, veteran loans, and first-time buyer FHA loans. So these two organizations make all the rules on your qualification. Make sure you run credit, make sure you verify employment. 3 times now we're doing that during the process to make sure you're employed, right? Because of COVID-19 reduction in the workforce.
Right.
So they're doing they make the rules. They buy the loans. They securitize the loans and they sell it to investment firms. So the whole industry is run on the fact that they buy the loans.
Right.
Very important. If they don't buy a loan, it's very detrimental to a mortgage company. So follow me for a minute. There's 2 things that the government can be doing that would immediately drop interest rates, in my professional opinion. And it's a travesty. All Americans are paying. Just think about it. If half the people are eligible to refinance at $11 trillion and they get 0.5% better, how much are they robbing the American people?
Yeah.
I don't think my calculator goes that high.
It doesn't. I tried. It doesn't go that high.
So let's 2 reasons. First of all, remember we talked about the servicer. Now, the servicer collects your payment. And the servicers are typically one of 2 organizations, a bank or a mortgage banking firm that's not a depository.
Okay.
So you got banks that are depositories, and I always call it the Big 6 cartel.
Wells Fargo.
I might get in trouble again, Jay, right? I call them a cartel because they are too big to fail, and the government loves them because they can fine them a lot of money and they can control them because the government likes to do that. And so you got the Big 6, 7 cartel. They have access to, they do half the loans. They service, they collect the payments. And the other ones are the mortgage banking firms that are independent. So the banks have access to the Federal Reserve open window. Now, remember when they dropped interest rates about a month and a half ago? From 0 to 0.25%?
Correct.
They did that so that the depository banks can go and borrow money in case there's a run on the banks.
Right.
Kind of like there was a run on toilet paper.
Right.
Well, what if everyone went and took $2,000 out of their bank in one day?
Right.
The banks would need to borrow it. They have the money, but they don't have it liquid.
Correct.
So you can borrow money 0% from the Federal Reserve. And the Federal Reserve's an organization trying to keep the flow of money. So the banks have access to that, but the mortgage banking firms don't.
Okay.
Why is that important? This is it. During the CARES Act of forbearance, if you skip your payment for 3 months, the lender, one of the 2 entities that collects your payment, has to make the payment to the investor.
Okay.
Who's carrying that money?
Right.
Now, remember we talked about the cascading effect. Let's say it's 6 months. You skip your payment for 6 months. So you don't pay $2,000 a month for 6 months. That's $12,000.
Right.
Multiply that by 10% of all homeowners that are doing it right now.
Right.
It's a lot of money.
It's a very big number.
Exactly. Well, the banks can go borrow money from the Federal Reserve at 0% because when you eventually pay them back, they pay the money back to the Federal Reserve.
Right.
Keeping the flow of money. Well, the other group of institutions who are non-depository can't borrow money from the Fed at no, all they have to do is open the window up. They call it the open window.
Right.
Where non-banks can borrow the money because they still have to forward the payment to the investor.
Right.
So it's caused a tremendous amount of liquidity crisis in the mortgage industry, and all Congress can ask, the president can ask, FHFA they can all ask and say, look, make it eligible for these non-depository banks to access the open window to borrow money because Americans are going to skip their payment and they can forward the money to the investor.
Right.
The reason why it's costing all Americans 0.5%, it's really simple. If you have to make more profit to come up with the liquidity for that,
Right.
prices go up.
Right. Right.
When you make it more difficult. When you say, look, you still have to make the payments to the investor, but the consumer doesn't have to make the payment to you, where are you going to get the money?
Right. Money's got to come from somewhere.
It's got to come from somewhere. But that's what the Fed is for, liquidity.
Right.
So why wouldn't you not open up to non-depository banks liquidity there? That's number one.
Okay.
That would drop interest rates right away because prices would come down.
Right. They don't have to they have to build in that extra profit in there.
Exactly. To
Right.
survive, right? Not to pocket their book, to survive.
Just to survive.
But here's the second one, and you'll love this. And thanks for staying with us on this, because this is affecting your pocket every day. And this is going to affect your deposit over the next 30 years because you're going to pay 0.5% higher. Remember I talked about the two institutions that buy loans, Fannie Mae, Freddie Mac, run
Right.
by FHFA.
Correct.
Mark Caballero, I think I'm saying it wrong, but I'm close, okay? He's the boss. He's the one that makes all the rules.
Okay.
Last week, very interestingly, he said that if you buy a house, you're a couple in Valencia, California, buy a house for $500,000, you get a $400,000 mortgage. You're happy. The lender here in Valencia does a great job. We go to sell the loan to them because they're the ones backing the loans.
Right.
You did everything right as a consumer. And you exercise your right for a forbearance and skip your first payment. Let's say one of the two borrowers got reductions in hours.
Sure.
Nothing we could do about it.
It's happening
If
all
you
over the place.
exercise your right under the CARES Act, we go to sell that loan, they're going to charge us 5% to buy it.
5% just to buy the loan for letting somebody do what they're allowed to do.
They're going to charge the lender 5%. Well, we only make as an industry 0.5% on the loan after all said and done.
Right.
They're going to charge us 5% if you exercise as a consumer the right for a forbearance under the CARES Act. David, gets better. If you did a refinance and just lowered your rate, straight you went from 4% to 3% with a 3.2 APR.
Right.
You drop your rate, your payment's great, because when you drop that rate, you put money in the system because now a consumer can spend more money,
Correct.
right?
Correct.
And you exercise your right under the CARES Act to offer a forbearance and miss your first payment, they're going to charge us, the industry, 7%.
Wow. That's crazy.
to sell the loan. And the only way we provide more money to do another loan is to sell the loan.
Right. Right.
What gets better, this is the crazy thing. Let's say you've been dying for lower rates. You do a cash out refinance. Same $400,000 loan. $300,000 you owe to your old lender.
Okay.
You have a home equity at your local credit union or bank for $50,000 and it's at 5%, so why not drop the rate?
Right.
And you have a student loan because your kid got through college and you're fired up for $50,000. You borrow that same $400,000. Again, 3.25, whatever the rate is, right?
Right.
With an APR slightly higher. We go to sell that loan to them, but you exercised your right for the forbearance and miss your first payment. The industry, they won't even buy the loan.
They won't even buy it?
It's a new rule they make last week. So what's happening is the entire industry has raised prices to make more income to cover this new rule.
Right.
Now, if a forbearance is a promise to pay, then why would they charge extra? Number one.
Yes.
Number two, we don't have access to the federal funds window to cover free money during this transaction. So all of a sudden, one institution, FHFA, created all these new rules stopping liquidity in the secondary market. How does it affect the consumer? Because that's what's most important. If you allow access, if you the groups that are the servicer that doesn't have access to the open window, if you open that, interest rates drop because now we're not covering your mortgage payment, number one. And number two, if you can get FHFA to stop penalizing the consumer through the lender if they want to skip their first payment, you free up liquidity. You free up liquidity, it's basically a tax on the industry, which is a tax on the people, because we have to raise prices to cover that money that's going to FHFA. Now, what are they going to do with the money? Because the consumer's promising to pay
back. Right. Exactly. So where's all that money go that they're charging us?
It makes no sense whatsoever.
Out of nowhere.
Interest rates would drop right away. And it should fire up everybody because, I'm sitting across from Patty. He's running the board, right? He wants to buy his first house. Now, for the next 30 years, he's going to pay 0.5% higher.
Right.
Because someone in D.C. thinks, why don't we stick it to the banks? Well, when you stick it to any one group, you're sticking it to the consumer.
Right, because that higher price is going to flow through,
Yep.
and it's going to end up being in the consumer's pocket.
And the profits aren't higher. It's
Right.
just we have to charge a higher price to cover these new rules. Now, what's FHFA going to do with the money?
Right.
And I get fired up on this because it's terrible. If you're the consumer, call FHFA and say, why are you charging a premium to the industry?
Right.
If I exercise my right under the CARES Act to exercise a forbearance.
For money that's going to be paid back.
Anyways.
Right.
Exactly.
So
anyhow, I want to get that out there. I hope this goes viral. I did a video on it on our
Right.
Facebook page
Yeah.
because it's wrong. And if those two things would just be done, interest rates would drop by 0.5%, helping all the $5 or so trillion dollars in loans and consumers to refinance at lower rates.
Right. Yeah, again, if you want to get, a little shameless promotion, if you want to get a really good granular understanding of this, Fred did a great video. It is on our Facebook page, American Family Funding Facebook page. It's a great video. It's about 15 minutes, but it's well worth it, and you will have a complete understanding of why the entire American homeowners are all being extra taxed for no reason. So I would really suggest everybody go in to watch it and then share it. Because you're right. This thing needs to get out there.
Great, thank you. Well, let's jump to a quick break,
Okay.
and I want to go to the positive side.
Right.
Because I'm a glass 3/4 full when
guy.
it's almost empty.
Exactly.
Okay, and I think it's the greatest opportunity once these rates drop, and I believe they will.
Right.
I'm not supposed to predict, right? But there's a good possibility, in my professional opinion, they will. And I want to talk about how it's a chance of a lifetime for the generation of young Americans to get into a home.
Fantastic.
Yep. You're listening to AM 1220, FM 98.1 on KHTS, hometown station online. We'll be right back.